Okay, thanks everyone for joining us for this this video presentation. This is we are recording this as a webinar. However, given the sensitivity of this topic, we've actually decided to pre-record it. We probably thought it was probably not appropriate, people wanting to register, obviously, and we understand the sensitive nature of this topic. So we have pre-recorded. If you do have any questions, do come back to us and we can assist you. But what we wanted to go through today is divorce and relationship breakdowns. Unfortunately, the statistics kind of tell us that divorce and broken relationships are kind of a fact of life. 1 in 3 first marriages and 1 in 2 second marriages tend to end in divorce based on the statistics. So what we wanted to explore in this webinar is really some of the areas that may impact you and where you might need assistance from an accounting to tax and tax perspective. And really obtaining some proactive advice early stages really can help avoid some longer term problems, and I could even say inefficient tax outcomes and also some surprises. And we've worked with a few clients that I look at what we've been able to contribute, and had they not received the advice, their position would be significantly worse than what came out at the end after our advice. So today I'm going to, for those of you that haven't met me before, my name's Shannon Smith. I'm the founder and managing director of Smart Business Solutions here in Mornington. I'm being joined by Erin Turner, who's one of our accountants, one of our superstar accountants. Actually, she's been a finalist in many of the National Accounting Awards. And we're going to go through some of the different tax aspects in relation to divorce. So going through the agenda today, we want to talk about accountants' involvement in the process. What are some of the key tax issues? So CGT, Div 7A, GST, also stamp duty, and then some of the structure issues you need to consider, and then what potentially might be some of the next steps. So if I talk about firstly, why would you actually involve an accountant in the process of divorce, when many people would think, well, I just need a lawyer to get through this divorce. Now, we've had a lot of great examples on the value we've been able to help with clients in going through this process. We should be involved, tax advisors should be involved as early as possible. Legal advisors on courts, unfortunately, they're awesome at what they do, but they actually overlook the tax issues or may not fully understand the rules in relation to the tax issues. And a client, and we'll give you some examples as we go through, would end up inheriting a significant tax liability unbeknown to them. And they may not even find out about this until 2, 3, 4 years after the divorce. And we'll go through some examples for you on that. So why is it important to, involve accountant? We will assist in determining the appropriateness of the income reported by either spouse. Now, sometimes when you're going through for a divorce, there will be some challenges. It may not be a friendly one, and there will be some challenges coming about where one party is trying to hide income from the other party. And trying to reduce the income. We can assist in having a look and making sure that it, passes a sanity check from that perspective. Help uncover some hidden assets if things don't seem to make sense, because sometimes assets do go missing in going through a divorce. And determine the value of closely held businesses. So sometimes we might act as the independent kind of value and do a valuation on a small business as part of coming up with what the marital pool is going to be. In particular, determining the income tax implications, and this is really important when it's related to not only your family home, any investment properties, businesses, taking money out of businesses. We'll go through a lot of these issues as we go through this webinar. And then just helping you, it is a trying time, trying to help you keep on top of your financial situation and compliance requirements, and then also tax effective and proactive structuring for the assets of the financial settlement. So that's really the areas we see that we can add a lot of value to clients and really help you through this process. The one thing we don't want to have is the surprises that come out 2, 3, 4 years after the fact, that unfortunately we've had to actually deal with new clients when they've been surprised that they've got all of this tax that wasn't factored into the financial settlement. So I'm going to hand you over now to Erin, and she's going to go through our CGT issues.
Hello everyone. Yes, to start us off, thank you, Shannon. We will be going through the CGT issues. Now, CGT stands for capital gains tax. So for those that don't know, you will usually pay a tax on any capital gains you make. So for any quick example, if you say bought an investment property 2 years ago for $500,000, sold it today for $600,000, you're generally going to pay tax on that capital gain of $100,000. In saying that, there's usually other factors to consider and usually a couple of discounts. So for example, the most common one being 50% discount. But this is also the case when going through a divorce and transferring your assets. So we look at the first box we have, it's transferring of assets would normally trigger a CGT event. So same scenario, if you say have investment properties with your former spouse now, if you were to transfer that property over to them, that would normally trigger a CGT event. The next step we're going to look at is you may actually potentially trigger market value substitution rules for both parties. So generally speaking, when transferring assets between a marriage breakdown, there's not going to be consideration transferred for that property or for that asset. So for example, if I'm using the example I said before with an investment property, if you transfer that investment property over to your former spouse, generally they're not going to pay you consideration for that property because it's usually some form of agreement that you've decided who's going to be keeping what assets. So that's when the market valuation substitution rules apply. And then moving on to the next box, the next issue is you could also potentially reset the acquisition date. This can be sometimes a bit of an issue, especially if you're currently holding a pre-CGT asset, which are quite rare to find these days, but that could also raise that issue. And then the next one we have is resetting ownership period for main residence exemption. So we move over to rollover relief. So in saying that, I talked about the CGT impacts on my last slide. There is actually a rollover relief that the tax laws do allow. So we're looking over at these 2 dot points. We have the automatic relief if conditions are met, which I will go through again shortly, and the capital gains or loss are disregarded. Do note, it is important to speak to your accountant at this point, because if you do actually meet these conditions, you can't actually choose whether or not you want to keep the rollover relief. You actually have to go through with it if you meet those conditions. So it is really important to engage your accountant quite early, as we have found that some people believe they might qualify for the rollover relief where they actually don't, or some people that do qualify don't go through with the rollover relief, and that's also another issue in itself. So we move over to the next slide. So I'm actually going to go through the transferee, what happens when you acquire the asset. So if you're looking at these points here, so if you do meet the conditions, which I will go through in the next slide, the transferor spouse would actually disregard any capital gain or loss that would usually arise when transferring an asset. Now, as the transferee, if you acquire the asset, you will keep the former spouse's cost base. You will get the former spouse's acquisition date. The CGT discount period is preserved, and the pre-CGT asset status can be preserved as well. Moving on to the next slide as well. So now these are actually the conditions. So these conditions are quite strict. So if you do meet them, it is important to actually include the rollover relief when looking through the assets and determining what assets you will actually inherit. So if we look at the conditions, again, they are, this is just a very brief overview, but there are 3 that we do have on the screen. So you can see it's made by a court order. So a court order made under the Family Laws Act or equivalent law for de facto relationships, a binding financial agreement under the Family Law Act or equivalent binding written agreement for de facto relationships, and an award made under arbitration under the Family Law Act or equivalent for de facto relationships. I will also point out that if there is a foreign agreement in place, that this could also be one of the conditions to meet as well. So if you had a binding financial agreement from a foreign law, this would also be included in this rollover relief. Do be mindful that I know there's probably a lot of couples out there that decide not to go through lawyers, try to save a bit of money, do a civil agreement, and in most cases that can work quite well. But in saying that, if you do just have a civil agreement in place, that you don't actually qualify for the rollover relief, because I said before that these conditions are quite strict, so they do have to be made by a court, or you will have to have an actual binding financial agreement. So if this does sound like you, I would actually suggest reaching out to your lawyer at this point as well, because you may need to get that civil agreement approved by a court, or again written up as a binding financial agreement. So now if we actually go through an example, so with rollover relief, we have Tony and Sharon. So Tony and Sharon's marriage breaks down in 2019. Tony transfers a block of vacant land to Sharon because of a court order made under the Family Law Act. Tony acquires the land in 1989 for $35,000 and incurred incidental expenses of $2,000 at the time of purchase. The value of the land at the time of transfer to Sharon is $280,000. Due to the operation of the market value substitution rules, Tony would normally make a gross capital gain of $243,000 upon the transfer of the land. However, the capital gain made by Tony is disregarded. The land's cost base in Sharon's hands is $37,000, and Sharon is treated as having acquired the land in 1989 for the purposes of CGT discount. If we just go back to one step where we see the gross capital gain of $243,000. Now, this is actually made up where it says where the market value of the land is $280,000 at the time. So this is actually what you'd say is the proceeds that Tony would have got had he sold the property. And then obviously it's less the cost base. So the cost base being $35,000. So the cost of the land and then plus his incidental expenses of $2,000. So that's how the $243,000 is made up. So in most cases, Tony would have actually incurred a CGT, so capital gains tax. So in normal circumstances, when he sells the property, he would be paying tax on that gross capital gain of $243,000. But usually there is, like I said before, with the 50% discounts. Now, as we're looking at it, he's actually been ordered by court to transfer this land. So this is why the rollover relief applies, and he doesn't actually have to pay any of the tax on that gross capital gain. So this is really just re-emphasising what I've just gone through with rollover relief. If you're going to take anything away, it is probably this slide in particular, because it's just the most important points of rollover relief. So if I quickly just go through the dot points, we have, informal arrangements or agreements reached between the parties would not qualify for the rollover relief if they do not fall within at least one of the categories mentioned earlier. So this is where I said it has the strict conditions. So it is important to make sure that you do fall within one of those. The next point being for transfers that happen because of a binding financial agreement, arbitral award, or binding agreements used by de facto couples, the rollover only applies if the CGT event happened after 12th of December 2006. So it is important that there is a date that this actually was implemented. So for transfers that happen because of a binding financial agreement or a binding agreement used by de facto couple, the rollover only applies if the spouses are separated, there is no reasonable likelihood of cohabitation between being resumed, and the transfer happened because of reasons directly connected with the breakdown of the relationship. Now, the rules relating to marriage breakdown rollover require the particular arrangement to be made as part of a court order or binding financial agreement made under the Family Law Act. These are legal concepts. So this is why it is critical that tax advisors work closely with legal advisors in order to ensure that the tax impacts are taken into account as early as possible. Now, this is where we find say one party, there may be, so for example, a couple, so you've got your mum and dad, one may have a business involved. So generally speaking, you already have your family accountant, so you have your accountant going through your divorce, going through your assets at this point. Now, this is where it's important to make sure that both parties in particular have had the tax advice to say who actually qualifies for the rollover relief, because you may come to an agreement today as to who's getting what assets, believing that you are qualifying for the rollover relief. But say everything's finalised within this financial year, you go to lodge your 2021 tax return and you don't actually qualify for rollover relief, it's too late, because now you actually be up for that tax bill. So it's really important to engage with your accountant and lawyer quite early to ensure that if you're kind of agreeing on what assets to keep at a certain point, that you're actually going to qualify for the rollover relief that you think you're entitled to. So that's just really important to remember, to actually make sure that you do qualify before agreeing or thinking that you do. So that was kind of on an individual basis, so the assets that you hold individually, but now we're going to look into transferring involving entities. So what happens when there's assets within an entity? This issue is actually quite more complicated than the individuals, but I will go through it in a bit more detail. So we go into the next slide. So we've got transfers from an entity. So basically, so you've got your special cost base adjustments when it involves an entity. Now you do also have the reduce the cost base of shares, units and loans to reflect the decrease in value of those interests. And you've also got to increase in recipients' cost base in certain situations. So if they are assessed on revenue account. So again, I won't go into this too much detail because it is really on a case-by-case basis. So we do have 2 examples to show. So this one in particular is if you're a sole shareholder. So if you are a sole shareholder, do read through this example as it may relate to you. But again, it is important to actually engage with us or your accountant at these stages because, again, like I said, it is a very case-by-case basis. So this is the example for the sole shareholder, and this one's for the multiple shareholders. So yeah, may not be relevant for everyone, but these are the examples there for where to start. So moving into the main residence exemption. So main residence exemption, so before, when I had the example of selling a property, now if you currently live in your home, so you're paying off your mortgage for your family home and you sell it, usually there's a main residence exemption, so you don't actually pay tax on any gain that you make. This is also included for when you go through a divorce and sell your family home, though there's another issue to kind of consider, and it's quite an important one to consider because one of you may be up for a bit of a tax bill if you don't. So you can see here where it says spouses can generally only have one main residence exemption between them at a particular point in time. So this is only relevant for the periods when individuals are treated as spouses. So, if you have been living in your family home and then you did sell it, you would have got your main residence exemption. But if you do have multiple main residents while spouses, so this is generally when you're currently going through a divorce, you're usually living at different houses at this point in time, so you probably have two main residents, so each individual has a main residence. This is when you would have to choose one of them to be exempt or split the exemption across the properties. Now, the reason why the ATO has this point, so where you have to choose one or the other or split it, is just so there's no double dipping. So there's only one property at one point in time, that's the main residence exemption. Again, I keep saying, but it is really important to emphasise that you do need to speak to your accountant, because if you do go through an agreement and think that you are covered by this main residence exemption and it comes to time of selling, you may be up for that tax bill. So again, if we go into the next slide, I believe there should be an example. So we have Jerry and Liz that are married. Jerry owns the family home, which has been bought in 2010. They separate in 2015 and Jerry moves out of home and establishes a new main residence. The divorce is finalised in 2016 and Jerry transfers the property to Liz. Liz sells the property in 2020 and she has always used it as her main residence. So this is where I said the example before, if you're currently going through a divorce, you may still be living together or you may have already moved into separate houses. This can actually be where it gets quite difficult, because on one hand, the property has always been Liz's main residence exemption. So it makes sense that she would be entitled to the main residence exemption. However, the rules seem to indicate that prior to the change of ownership, you look at the way in which both of the spouses were using the property. So if you see Jerry, he did actually move out of the property. So Jerry didn't live in the property between 2015 and 2016 as he had another main residence. So there is a risk that Liz would only be able to apply a partial main residence on the sale of the property. Very fact specific. So this is where most people would be, speaking with their lawyer, and most people in general usually assume that the main residence exemption would apply. So reading this, it would look like Liz would definitely be entitled to the main residence exemption. So most people do assume it would be tax-free at this point, but there's an actual law that does state that this would have to be considered where she may only be able to apply part main residence exemption. So in this scenario, if she didn't consider this, she may be up for a tax bill come to the time when she sells the property in 2020. So it is really important to know this law, because you don't want to be up for that tax bill when you go to sell your family home later on. So if we're moving into depreciating assets, so the transfer of depreciating assets would ordinarily trigger a balancing adjustment, which then moves into an automatic marriage breakdown rollover. And then if the conditions similar to CGT rollover, oh, sorry, I've lost my place there. Yeah, so you're transferring a depreciating asset. So we'll use just the main example of, you know, a motor vehicle. So if you are transferring a motor vehicle between spouses, you do have the automatic marriage breakdown rollover to consider, as this may be applied, and the conditions are similar to the CGT rollover. So like I said, the most common form of asset is your motor vehicles, and you can be up for the rollover exemption. So there would not be a balancing adjustment to consider, and no tax would be payable. But then again, it does depend on the assets, and it does depend if you are actually if you do qualify for the exemption on the depreciating assets.
Great. So now we're going to move on to dividends. And it is the payment, a dividend that's being paid. So care needs to be taken. And this is one thing that is quite frequently overlooked when focusing just from a legal perspective, is that care needs to be taken when transferring assets from a company. Often if you're running a business, one of the spouses that's running the business might say, well, I'll just take money out of the business and I'll use that to pay out the financials for the marriage or relationship breakdown. So even though we may be able to do the transfer of an asset, as Erin's just gone through, we may not have any capital gains because of that transfer of the asset. There's still potentially, once that asset then leaves, in a sense, that cash or the asset leaves the business, leaves the company, it can still trigger what we call the dividend rules, or a loan to the shareholders. So many of you who are operating, if you operating a company, you know that if you take money out of the business, there's 3 ways you can take money out of the business. For tax purposes, you obviously just take the cash out of the bank or the asset, but it will be either through a dividend, wages, or a loan that you owe to the company. So when you are taking these funds out, despite the fact that you have that exemption, as Erin's gone through, from a capital gains perspective, you've still taken money or assets out of the business, and that potentially could be a dividend that will then may have franking credits on it or may not have franking credits on it. So that triggers, I guess, what we call that Div 7A. Now that's very accounting speak. Those of you who would run a company may hear us talk about Div 7A. Basically, that means you're taking money out of it's a payment of money, money or transfer of an asset out of the business, out of the company, to either a shareholder or you know, maybe the other spouse in this situation. It could be, again, what we talk about, deemed dividend under Div 7A. This distributable surplus could apply, and it may be franked or may not be franked. So this is something to really talk about with your accountant, to make sure you understand the implications, because if that money gets taken out, so let's just say that you did take the car, and you know, Erin's told you there's no capital gains, so we're all good on that, but the car's worth 20,000 and you take that comes out of the business, that needs to be recorded and paid as a dividend. And who is the one that's going to be getting that dividend in their tax return? So it's important when you're looking at these types of aspects that you look at all areas of the business and the implications going forward. I often find when we're going, you know, when we see clients going through a financial settlement, there'll be a list of assets. I frequently don't see any tax implications considered, and then they just split it 50-50, yet after the fact, all of these tax issues come out and someone's got to pay this tax. So an example of this, just to give it to you at a high level, is Mr. and Mrs. Smith's marriage breakdown. Mr. Smith is a sole shareholder of the company. He's been running the business. The company also owns a holiday house, which obviously we wouldn't normally advise to put a company in a holiday house in a company, but let's just run with this. Has a cost base of 120,000, market value of 300,000. Family court orders said that the company should transfer the house to Mrs. Smith. Potentially that's a capital gain of 180,000 for the company. Now, because of the rollover relief, we could apply the CGT rollover relief to not have the capital gains. There would be the cost base of the property for Mrs. Smith should be taking over the value of the cost base. This will do an adjustment on the cost base of the shares held by Mr. Smith, as Erin talked about earlier, about the potential adjustment of the company. But the next bit, and this is where then the tax kicks in. So maybe you think, great, I've got no CGT, all good. Now there is a deemed dividend because money or asset has been taken out of the company to Mrs. Smith of 300,000. So Mrs. Smith goes off, she's got her property, she thinks it's all great, and next minute you know, she gets a dividend statement from Mr. Smith's accountant saying, that property you took, here's your dividend. There's some franking credits, but potentially you've got extra tax payable on that dividend. So it's really important. It's very case specific, but really important that you get that part signed off so you don't have any surprises later. Another one, going back to what Erin talked about, the transfer of assets with, for example, using the car. So for CGT, we can get the rollover. So that's great. However, GST, there is no rollover. For this situation. So when an asset is transferred by a GST registered entity for no consideration, the market value substitution rules will generally be triggered, and that basically it means it's not a taxable supply. However, if the asset has been applied for domestic or private use, it may be an increasing adjustment. So what we're trying to say there is, if you have the car that you say the spouse takes out of the business, you can't have a situation where you kind of, you've already had the GST back on that, and now the car's gone. And now it's not considered what we call a taxable supply. So it's kind of not going as a transaction with the GST attached, that you have to charge GST to the spouse when they take the car. But you then have to make on your BAS an increasing adjustment. Kind of you're pretending it was a taxable supply, because what the tax office is saying is, if you bought a car for $20,000, which had GST of $2,000, the ATO kind of gave you that $2,000 back. You have now transferred it for, say, $10,000. It's worth $10,000. Market substitution, it's worth $10,000 now. You've transferred it for $10,000, but they're actually going to make you record, even though you don't have to pay tax. Well, it's actually a loss, but you don't have that kind of implications. It's the GST aspect that you'll have to make an adjustment of $1,000 on your BAS, because the asset has left the company in this situation, or left the business. So there will be an adjustment that's made. So that kind of, for example, when we're working with clients on looking at their financial settlement, we will get the financial settlement from the lawyer, which will usually be all the assets split by 2, and this is how it comes up with. We will then look at all of these issues to say, well, hang on a minute, you've got a pooled assets of $1 million. You think you're getting $500,000 each, but did you know, because the car is coming out of the business, you've actually got an extra $1,000 of GST taxes that you're going to have to pay. So you're not getting a $500,000, you're getting $499,000. Did you know that this property that you're selling, or the property you're pulling out of the business, as I talked about earlier, yes, you're getting the property and no CGT, but did you know that's now going to be a dividend? So you're going to have these extra taxes. So that $500,000 you think you're getting as 50-50, it's not. So we like to work with the lawyers to actually come up with the tax implications, so that when it comes to splitting the 50-50 or the 60-40, whatever the split is, it's based on what would be an after-tax net asset position. And that's really important. I think that's often overlooked. So definitely worth having a look into that. So as I talked about just before, and just an example, I've gone through the car. I think I've nearly covered all of this example, but you will have that adjustment paying back on that as well. Stamp duty. Stamp duty is a big one. Now, I had a really recent example of this one. So I'll go through that and save the client as part of the marital assets over $50,000, which was a great outcome. So generally speaking, spouse and domestic partners, obviously you transfer property between themselves. This can happen with or without a marriage breakdown. Now, without a marriage breakdown, prior to 2017, all properties between spouses were not subject to stamp duty. Post July 17, only transfers of the principal place of residence for no consideration are exempt. So if you're not going through a marriage breakdown and you want to transfer investment property, there will be stamp duty. So I think that some accountants get this confused, or it was maybe strategic planning on their side. I'm not sure, because I've seen this error now a few times. There was no, when the rules changed back in 17, there was no change on the transfer due to the breakdown of marriage or domestic relationship. So the transfer is made solely because of, if it's solely because of the breakdown of a marriage or domestic relationship, it is exempt from stamp duty. So that there are specific requirements. But this, there's no restriction on the type of property. So this can be an investment property or it can be your main residence. Now, the reason I say this is important, I had a new client to us, example. She was going through a divorce. Her lawyer had given her the summary that they had received from her ex-partner's lawyer, who had worked with the accountant. And they had come up with the total asset pool. Now, in that asset pool, they had allowed for stamp duty taxes. So they'd gone through and come up with a settlement post-tax dollar settlement asset base, post-tax dollar asset base, and then had split it accordingly. Now, they had a number of investment properties. They had three, I think 3 in total, plus the main residence. The accountant had applied. Now, I don't know whether they're just being cheeky and trying to just add it in for the sake of adding it in, or whether they were just incompetent and didn't know the rules. So it could have been one or the two. But the accountant had added in the cost of stamp duty for transferring all 3 of the investment property. So this is what I say. I don't know whether the accountant was applying these new rules but didn't realize there was no change in the marriage breakdown rules. So they're like, okay, main residence, no stamp duty, anything else, stamp duty. And so with those 3 properties, it was like over 20,000 of stamp duty for each of them. That had been taken off to come up with the net assets post-tax that would then be divided between the parties. Now, what would have happened is, had this person not call our office and say, hey, can I just meet with one of the accountants? We actually only spent a total of like 2 hours in total of working through this with them. Had they not got that reviewed, she would have probably accepted that, thinking that, oh, of course, the accountant's done that and that must be right. And yet when they would have transferred the property, her ex-partner would not have had to pay that well over $50,000 in stamp duty. So he would have ended up a lot better off, a lot better off in that situation. So it's really important to get your own advice. Her lawyer actually said to her, look, you should get your own accounting advice just to make sure. And that was the best bit of advice that lawyer could have given, because she was absolutely wrapped. I kind of paid for my fees about how many times over, just for a few hours, but the return around. So it's really important to make sure you get that advice from it. Now, going on the structuring, just to have, and these are just a flag, and these are very, very specific. If you have an SMSF, speak to your accountant. Both speak to your accountant, even though the SMSF will be with one accountant. Make sure the other one has access to the information. Divorce and relationship breakdown is one of the few times when it's actually possible for one person's super to be moved or split to someone else. Now, this also might mean you want to talk to the accountant that is the financial advisor, like ourselves, because we actually recently had this situation over the past year. And whilst they were going through a divorce, we were actually able to come up with some financial advice. We had to go through a financial plan for the client, but we were able to come up with some really great financial advice for the client, because with this client, the age bracket was about 10 years age bracket. The older spouse didn't have the ability to contribute more to super at this point in time, whereas the younger spouse did. Now, as part of this settlement, we were able to come up with some strategies that meant, well, look, if our older spouse can't put more into super and he would like ideally more in super, why don't we, as part of the settlement, have that part of her super gets transferred to him, so it all stays within their self-managed super fund, and some of it she rolled out to another super fund, that's fine, and that he makes cash outside of super, to true up the splitting of the overall assets, because the SMSF assets, they come as part of that pool. The superannuation comes as part of the pool. So that was a really great outcome for both parties in this situation, because it's the only time when you can transfer super between people. When you've got an SMSF, it's not try and keep things amicable as much as you can, because you are in a joint self-managed super fund. Now, that's okay if you have investments which are easily turned into cash, but how is this going to be if you've got one asset in there, like you've got a factory in there? How do you create liquidity to pay out the other spouse? Does one of them have to put more money in? Can they make those contributions? So there's some of those issues that need to be considered as well. And then also, what about the member balances? In your member balance, there will be taxed member parts of your balance, and there will be preserved components. So when we go through this, we try and have a look at how can we come up with the most tax effective outcome. So it's really important to get into the details. There can be some really great structuring opportunities when this situation is going about. Now, if we go on to trusts, just to flag, your lawyer should be all over this, and we can work with the lawyer, but there will be amendments to the deed, potential resettlement issue. That one's just got to be watched. The lawyer will be able to do that. Again, looking at the CGT, and then also some variation if there's a specified individual in what we call a family trust election. Your accountant will need to look at that. And then also the control test under trust losses if there is losses. So it's really important that if you are operating a business, you have family trust, you have super funds, you've got to get advice and even have both accountants talking so that you can really make sure that you've got all of the information. So what are some of the next steps that we suggest? Now, I know some people, as Erin talked about, do want to do it themselves. I think it's always good to go and get an expert. That's what they're really good at doing. You can do as much of it yourself if you want to, but you've got to see a lawyer, get them signing off on it, or see a lawyer from the start. Speak to your accountant. We've just gone through some of the issues today. We can add some real value to clients, or just make sure that they don't have any hidden costs. Think back to that example Erin gave of the main residents. What was it, Jerry and Liz? Think back to Liz in 4 years' time, goes to sell her main residence, and then the accountant says, oh, you've got tax payable on that. And she had no idea that there would be tax payable. Now, what we would have done is actually already calculated at that point in time a notional amount based on the value, say 4 years ago, of what that, for that 6 months, 12 months that he wasn't living there, what would that tax potentially be? And you might put that in notionally into the asset base. So the other thing to think about is whether you want a facilitator. Now, obviously, people don't want to go through divorce more than once. It's a very stressful time. You don't know what needs to happen. I am seeing popping up a lot of different facilitators. One that we've seen with some clients that's actually worked quite well, Divorce Angel. I've just put her details there. But that having that kind of person on your side, they can act as, I guess you could say, a facilitator. And one thing I know, one of the family lawyers said to me once, I always have to say to clients, they get very emotional with me, and that's fine. I understand it's stressful, but I really want them to use those emotions with friends, family, etc., because the lawyer charges obviously a decent amount per hour for their services. So do we as accountants. And a facilitator can probably really help you in going through, okay, when you speak to your lawyer, make sure you look at this. When you speak to your accountant, make sure you look at this. Here's what else you need to think about. So that's just something to think about, unless you've got a close friend who's been through a divorce that can help you on that. But something to think about just to give you that help, because it is a stressful time in going through. Now, also we do a lot of other webinars. You can like and subscribe on our YouTube channel. You'll get to know when we've got investing seminars, other tax seminars, business growth, lots of different areas. Yeah, if you'd like to like and subscribe. Normally at this point in a live webinar, we will actually say you can ask us questions. Now, we chose to do this webinar as a pre-recording. We did that to respect that this is probably a very sensitive time for many people signing up and putting yourself out there and signing up, asking questions. It's a very personal topic. So if you do have any questions, please don't hesitate to reach out to us here. We will reach out to any of us in our leadership team, myself, Shannon Smith, Paul Cunningham, who's also an associate, and Daniel McCulloch. Reach out to any of us, and also Erin. Reach out to the office, and here's our contact details, and we're happy to help you with any of your questions that you might have. But we hope you've enjoyed this, I guess you could say, recorded webinar. And if you have any questions, let us know, and we will see you on future webinars, potentially live in the future. Thanks very much.